And we're looking at an asymmetrical beta note, which means that this particular note captures 44% of the downside from spot price, which was 880, and catches 88% of the upside from spot price, capped at 38.9%. Horizontal line represents price. So right here is 880. As we go up in price, you make money. That's the red line. As you go down in price, you lose money. Then again, the red line. So losses on the bottom, profits on the top. Price, profit, loss. P&L, that's what it's called, a P&L. Price, profit, down, loss. Now, in this particular example, we're looking at a structure, IPS custom raw structure. And we're looking at the blue line represents what you would do if the market should go up or down in essentially the next 0.75 years. This particular structure matures December of 2024. It's a short-term structure. Let's look at some of the important numbers. First of all, the investment is $200,000, and the investor puts $198,000 into a zero coupon bond. There's no coupon on this bond, so we're buying at a discount from par. Par value is $198, investing $198,000. Today, the bond would cost $190,274. So you're buying at a discount, and when it matures $198,000, but you're only paying $190,274. We are buying NVIDIA, the price of NVIDIA when the day we built it was $878.37. We're buying a call at 880. We're buying two calls, and we're selling a put at 880, and that's one put. And therefore, that gives us a 44% downside exposure, owning one short put, but owning two calls gives us a notional 88% upside exposure. And you could denote that by looking at this graph here. As the market goes up, you can see that market's up 30, you're capturing 27. Market's up 40, you're capturing 35. Market's down 40, you're only losing 16. It shows you your outperformance and your slight underperformance. What's nice about this note is it's built with a positive carry, 1.74. So if you build this note and December 15th rolls around and the stock hasn't moved, you'll end up making 1.6% on the note. If the market is down, NVIDIA is down 5%, you'll be down 0.6. If the market's down 10, you'll be down 2.8. But if the market's up 10, you'll be up 10. And that's very exciting. That's giving you asymmetry. Why would you own the stock if I can cut my downside risk in half, but participate in the upside? We are buying at a particular strike of 880, so we're slightly out of the money. We're 0.2% out of the money, call, and we're slightly out of the money on the put. The market's at 878, and we're slightly above the market at 880. So we have a little bit of what we call tracking error in here. We're also selling two calls way out of the money at 1220, and we're only receiving $82.78. So the argument could be, why cap the note, especially since you have such a positive carry and you have very positive underspend. And that's what these two numbers represent. We spent $4,455 on options. We could have spent up to the difference between 190 and 198. We could have spent essentially about $7,800 on options. We only spent $4,454 on option. Therefore, we have a option underspend of $3,281, or a positive carry 1.78. I do not have a problem building structures with a negative carry if I can get a substantially better participation rate. We also have, as I mentioned, an underspend of $5,281. So we're getting good upside participation, and we're capturing half of the downside. This is essentially how to read a P&L statement on asymmetrical beta.